Hello, this is Edward with nonaccountant.com, and this is our cheat sheet, the unexpected way to read your income statement and instantly know how to increase profits. I have to admit, I was once that accountant who would make your eyes glaze over, boring you during a financial presentation. It took me years to fully understand that no matter how simple I made accounting for business owners, it never was simple and crystal clear for them. I failed to realize that the information I shared was not actionable, and if something can't be acted on, why care about it in the first place? You always hear that accounting is important, assets this, and equity that, and depreciation this, and blah 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 blah. A language so foreign to you, so why should you care? You are going to learn a simple way to read your income statement, one of three of your major financial statements, to instantly improve your profits. I promise to make this as clear as possible. With our case study, we have Prime Care Home Care Services Incorporated. This company has 4 locations in Georgia. With what you will learn shortly, this healthcare company was able to boost their revenue from $2.8 million to $3.7 million within 1 year. Even though this agency's revenues were fixed due to state waivers, they were still able to spot gaps in their operations. You will learn that by making a slight adjustment to your income statement, something your accountant can do in your accounting software just one time, and that's it. Your income statement, also known as a profit and loss P&L, shows revenue minus expenses equals profit. So most business owners look at their income statement and they see this: revenue minus expenses equals profit. In reality, it tells you very little about what is going on in your business and the things that you have direct control over. With a slight adjustment, just by organizing your expenses into 3 distinct accounts, you can have superior insight into your business. Unfortunately, most accountants prepare income statements that give you, the business owner, no accountable insight whatsoever, just more of what you don't want: headaches. Your income statement should look like this if you want to instantly know how to improve your company. You take revenue minus direct costs to get your gross profit. You're then going to deduct fixed costs and then your remaining variable costs to get to your profit. So that's it. Just by separating your expenses into 3 distinct accounts, you can see where to focus your attention. So instead of revenue minus expenses to get us a profit, we're going to have 3 different types of expense accounts: direct costs, fixed costs, and variable costs. So let's break down each one of these. Direct costs, also known as your direct variable costs. This is basically the cost to produce revenue, your direct labor expense. Remember, it takes money to make money. In other words, this is the direct cost to produce revenue or sales. Fixed costs, things you pay regardless of if you make a sale or not. For example, rent, utilities, insurance, administrative salaries. Variable costs, also known as indirect variable costs. These are other costs that increase or decrease with revenue production, but are not directly tied to revenue generation. For example, office supplies, marketing, travel expenses, meals, and entertainment. Let's get a better view. So on the left, we have a standard profit and loss, and right below that, we have a customized profit and loss. And we say customized because it's going to break down, as you see, those expenses into 3 distinct categories. So on the right, we have both P&Ls have the same net profit, which is $10. However, this format tells us very little about how you operate the business. With your expenses organized into 3 distinct categories, you can quickly see where problems may hide in your business. Let's take a deeper look on the next page. So we have each account on the left. As you move to the right, you'll see the dollar amount, percentage, and the general rule. So we're looking at everything as a percentage of revenue. So if we take our revenue in this example, we have $100. Our direct cost, this is the money to make money, is $40. So that is 40% of that $100. So we have a 40% direct cost. And the general rule, you want to keep this under 70%. Now, when we go down, now we see we have a gross profit of 60. And this is pretty good because we have a 60% gross margin, and we want to maintain at the minimum 30%. Of course, you want it higher, but at the minimum for a standard company, no less than 30%. Now we're going to jump down to our fixed and variable costs. For our fixed costs, we have $35. That gives us a 35% profit margin. We want to keep that under 20%. So that's an area we want to focus on. And our variable cost is 15. That represents 15%. And that is under our 20% threshold. And that gives us a net profit of $10, which is a 10% net profit margin. So with our direct costs, which is also known again as direct variable, this should be low enough to create a gross profit of at least 30%. For example, if you make $1, then you should at least have 30 cents in gross profit to cover remaining costs. The lower your direct costs, the more efficient you are at creating revenue. Makes sense? Okay, fixed costs. This is higher than 20%. Overhead is too high and needs to be addressed. So we're going to look deeper into this number. And then we're going to end with variable costs. So this is indirect variable. This is lower than 20%. So it is not a major concern at this time. However, keep an eye on trends that can develop over time. So this is a simpler formula you can use. When you want to improve your profits, just keep this formula in mind. Remember, you are the CEO, so you have the power to make the following decisions. C, cut costs, E, earn more, or O, optimize spending. So to cut costs, use your percentages as thresholds. If something is unusually high, get rid of it. Earn more. You can always raise prices. I will show you how to get around this one if you are in an industry where prices are locked. Optimize spending. If you can't cut an expense, become creative and find ways to negotiate the terms or streamline the costs. This is a good strategy for your fixed costs. So back at our case study, let's jump back to Prime Care Home Care Services Incorporated. We assessed our current situation and found out our gross profit averaged 45%, which we want to keep over 30%. Variable cost averaged 3%. That's well below our 20% threshold. And our fixed cost averaged 39%. So we need to keep that below 20%, at or below. There was no way for us to raise our billable rate for waivered services. So what did we do? We got proactive and decided to do several things. We started by looking at our fixed costs, which averaged 39%, and took note of our biggest expenses. As you see, admin payroll, payroll processing fees, rent, and insurance. There was nothing much that we could do for reducing the administrative payroll. However, we renegotiated the remaining 3 areas. We did not bring the average down to 20%, but we made it to 27%. However, we did notice something interesting. Even though our gross profit averaged 45%, which exceeds our 30% target, we really wanted to see if our finance department was maximizing on billing all claims. So we analyzed to see if we were maximizing revenue. We investigated and found out that many claims were not corrected and processed in a timely manner. We hired a new biller to help with corrections while figuring out how to automate our process. Instead of manually submitting every claim, which took about 2 weeks to complete, we could submit an electronic batch that billed everything in an hour and automatically gave us claims that needed to be corrected. This move increased our revenue, thus bumping our gross profit to 62%. In summary, this is the unexpected way to improve your profits. By understanding how your income statement should be formatted, you have better insight into your business. First, have your accountant break out your cost into 3 categories: direct labor, fixed, and variable. Second, know your percentage thresholds. Third, use CEO to develop a dynamic action plan. And 4, review your P&L monthly along with your other 2 financial statements. Thank you for watching. Hopefully this video has helped you out, and download your PDF file of this so you'll have something on on file you can mark up and use in your business and share with your staff and your team, especially your executive staff, so they can, help you take action, help instantly produce a profitable company. Thanks for watching.